This is a bookball summary of the book The Little Book of Common Sense Investing by John C. Bogle. Choosing the right mutual fund can be overwhelming, much like picking the perfect chocolate bar from a vast array of options. However, by considering factors like security, risk tolerance, and market strategies, you can make informed decisions with your investments. To ensure you make the best choice, consider investing in index funds. These funds offer low risk and diversification, and are known to avoid tumultuous markets. Furthermore, they are a way to avoid the high fees and expenses associated with other types of mutual funds. So, if you want to give yourself an advantage, consider index funds as your investment option. This video provides an overview of the challenges of choosing a mutual fund and offers advice on how to make informed investment decisions. The author compares mutual funds to chocolate bars and highlights the wide variety of options available, making it difficult to decide where to invest. Actively managed funds are expensive and consequently often underperform the market. Investing in the stock market can be challenging due to the complexity of evaluating the value of a stock. This is why some investors opt for actively managed funds instead of directly investing in stocks. In these funds, money is collected from multiple investors and invested by a professional fund manager who continually assesses and adjusts the stock portfolio according to market conditions. However, actively managed funds come with significant risks. The fees associated with this type of investment, such as brokerage fees and the fund manager's fees, can quickly add up and significantly reduce your potential profits. Even if the fund performs exceptionally well, these costs can still outweigh the benefits in the long run. This is because speculating on stock prices is not a sustainable strategy, and the returns generated by actively managed funds are likely to be lower than the overall stock market performance. Moreover, when you factor in the high costs of actively managed funds, the returns are even lower. A more profitable option is a passive, low-cost index fund that tracks the performance of the overall market. In fact, a study shows that if you've invested $10,000 in 1980, you would have had 70% less in profits by 2005 if you invested in an active fund rather than an index fund solely due to fees. Few funds perform well, and there's no guarantee even those few will continue to do so. If you're still considering investing in an actively managed fund despite the high costs, it's crucial to examine its performance relative to the stock market. Sadly, the chances are that the fund might not perform well. Many funds have a history of underperforming or failing to generate substantial returns, even though investors pay large fees to have financial experts manage their funds. Out of 355 mutual funds that existed in 1970, only 24 have consistently outperformed the market and are still in operation. Investing in a fund with a proven track record might seem like a safe bet, but it's essential to keep in mind that past performance is not a guarantee of future results. The fund manager who contributed to the fund's success might retire, and future investment opportunities will differ from the ones in the past. As a result, investing in actively managed funds can be a risky venture that may end up wasting your money. In conclusion, before investing in an actively managed fund, it's crucial to weigh the risks and consider the likelihood of the fund outperforming the market. While some funds have a history of success, there's no guarantee that this success will continue in the future. Most people invest in actively managed funds unaware of all the implications. We have painted a clear picture of the poor performance of most funds, which raises the question of why people still invest in them. The main reason is that investors often overlook the high cost associated with actively managed funds. While fund managers may tout their high returns, they tend to hide the actual cost incurred by the investor after accounting for performance and portfolio fees. In fact, research shows that 198 out of 200 top-performing funds in the late 1990s overstated their returns to investors. If you're finding this video to be enjoyable, show your support by liking it and subscribing to my channel for even more fantastic content. Your encouragement means everything to me and drives me to keep creating videos for you. Another factor is emotional investing, where people let their feelings and market trends guide their investment decisions. Unfortunately, this often results in unsound investments, as people are swayed by popular opinions and marketing tactics. For instance, the late 1990s saw a surge in high-risk investments, with $420 billion invested in the stock market in the latter half of the decade, compared to just $18 billion in the first half. The bubble eventually burst, leaving many investors regretting their decisions that were based on popular hype. The same applies to actively managed funds, as investors flock to them simply because everyone else is doing the same. Therefore, it's important to consider alternative investment options that are more sensible. Put the majority of your assets in safe, low-cost index funds. Don't let your current understanding of actively managed funds convince you to keep all your savings at home. Instead, consider investing in index funds, as they provide a cost-effective alternative. Index funds, also known as passive funds, invest in a diverse portfolio of stocks that mirror a particular market or financial sector. Unlike actively managed funds, index funds do not engage in short-term market speculation, reducing both risk and operating costs. One of the main advantages of index funds is that they come with lower fees, as there is no need for buying and selling shares, financial advisors, or fund management services. This means you can enjoy the returns of the market without incurring high operational costs. Additionally, index funds tend to outperform actively managed funds over the long term. Although some might argue that holding stocks indefinitely, rather than timing the market, results in missed opportunities. Studies have shown that the ups and downs of the stock market eventually balance out, resulting in the real value of the stock. By following this approach, index funds offer returns that reflect the real value of the stocks, while also avoiding the costs of active management. Choose the cheapest index fund. An index fund is a type of investment vehicle that tracks a particular market index. Each index fund has an expense ratio that encompasses the fees charged by its managers and the costs of operating the fund. This expense ratio is usually expressed as a percentage of the fund's assets and is generally lower than 1%. Despite its relatively low value, over long-term investment, this expense ratio can significantly impact the overall returns of the fund. For example, the Fidelity Spartan Index Fund has an expense ratio of 0.007%, while the JP Morgan Index Fund has an expense ratio of 0.53%. Though both of these ratios are below 1%, over a period of several years, these seemingly small amounts can accumulate and impact the overall returns. When choosing an index fund, it's important to keep in mind that the expense ratio does not necessarily indicate the level of performance of the fund. Index funds tend to mirror the movements of the overall market, so it's advisable to opt for the fund with the lowest cost structure. By doing so, you can maximize your returns and minimize the impact of management fees and other expenses on your investment. Be wary of new investing trends. When deciding where to invest your money, be wary of the latest investment trends. The intense competition between index funds creates a never-ending cycle of new fads. Index funds were first introduced in 1975, and now there are over 500 of them competing with each other. Established funds try to attract investors by reducing their costs, while new entrants to the market offer higher returns through unique stock-picking strategies, but at a higher cost. For instance, the new Copernicans approach portfolio creation differently, avoiding the conventional method of weighting stocks based on market capitalization. Instead, they might base their stock allocations on factors such as a company's earnings or dividend payouts. However, it is almost impossible to accurately determine the over- or undervaluation of stocks, so it's best to stick with funds that maintain a balanced portfolio. Additionally, since the success of new investment trends cannot be predicted, it's advisable to exercise caution and prioritize low costs. In conclusion, actively managed funds come with high fees and significant risks, and are often less profitable than passive index funds in the long run. Index funds offer a more cost-effective alternative, with low fees and a diverse portfolio of stocks that track the overall market performance. When choosing an index fund, it's important to opt for one with the lowest cost structure, and consider the impact of management fees and other expenses on overall returns. The real value of stocks is reflected in index fund returns, making them a sensible investment option. We hope this video provided valuable insights and information for you. How do you invest your money? ETFs or single stocks? Let us know in the comments. And if you learned something new in this video, make sure to hit the like button and subscribe for more videos. Thank you, and until next time.